PCBs, toxins. And I picked up a report from a Welsh Environment Agency saying that the PCBs had settled, the toxins had settled around some very high concentrations of population, and that this caused a lot of contamination. But the company hadn't put this into their accounts, they hadn't put it into the report. And I, as a rather naive young analyst, decided to brave it and stand up and ask the chairman, given the extent of the PCB contamination, what provisions have they put in their accounts to deal with these liabilities? And the chief exec afterwards brought a couple of his guys over to have a very serious chat with me about the question that I posed. But I use that story just to illustrate what the world's moved on into, because those kinds of disclosures hopefully will become more commonplace instead of exceptional. But what it told me is that companies don't always give accurate accounts of what's going on in their companies, and that there is an expectation really now today for regulators and people to get this right, and just don't have to have always analysts asking these kinds of questions. But one of the things I learned as an analyst is always to really talk actually to look at the accounts and say, where are the mistruths, the misstatements, and the lies? If you can read through the accounts and get to the end of it, and finally, then probably you're dealing with a good company. But if they're material emissions, you really want to be thinking hard. Now, in the climate era where we are today, as we know, we're going to have to cut emissions by 50% over the next decade. And the fossil fuel system today, in Carbon Tracker's report, the size and decline of the fossil fuel system, I read it actually, it's quite it's worth reading. We identified $30 trillion of assets of the fossil fuel system: refineries, pipelines, gas-fired power stations, coal mines. And we're probably going to have to lose about half of it over the next decade or so. So it would, as an analyst, you would probably ask yourself, where are the write-downs? Where is this discussion of the provisions that are going to need to be made? And of course, as we know, we're not seeing it. And we have to ask ourselves why we're not seeing it, and where is the issue, where is the problem? And then these are the questions that really get to the heart of Carbon Tracker's work. When we were set up, we wanted to be a little bit different and hire ex-Wall Street and City of London analysts to lead the work in the team. And the reason for that is we wanted the smartest analytical minds to challenge the smartest analytical minds of Wall Street. And we were joined by ex-heads of research at Citigroup and ex-head of oil and gas research at HSBC. And through that lens, we could start to answer some of these questions. So that just sets the scene a little bit. I'm thrilled you're all here. I hope you enjoy it and do ask lots of questions.
Tracy, thank you very much.
Good morning. I'm Tracy Cameron. I'm with Ceres. And for those of you that are not familiar with Ceres, we're a sustainability nonprofit. We work with investors, companies, and policymakers to drive a sustainable economy. Ceres is also the North American lead for Climate Action 100, which is a global initiative to engage the most systemically important emitters on climate change. And investors are asking them about their governance, their actions to address climate change, and their disclosure of climate risk. So in the past few years, a critical mass of investment and lending dollars are committed to net zero strategies by mid-century. And investors are developing sophisticated tools to manage their investments and make sure that they're best positioned their portfolios for climate risk. The most important investor tool for evaluating long-term value is the financial report, and investors are finding that disclosure has not kept pace with the need to understand how companies are planning to deliver value in a net zero economy. Climate risk is financial risk, and clues to the magnitude of that risk can be found in the company financials. The impact of the energy transition on an oil and gas company provides an example. The need to reduce emissions means that either there will be a shift to new energy sources, such as renewables, or that traditional energy will need to invest in carbon capture at scale and in short order to continue to produce high carbon energy. Either of those outcomes will require large capital outlays that will be based on assumptions like the future price of oil, carbon prices, how long assets will produce revenue, what technology will be available, rate of adoption of EVs and solar panels, etc. Those assumptions can be vastly different from company to company, and financial institutions as well will have different models, but without clarity on what those assumptions are, investors are operating with blinders. The Climate Action 100 initiative developed a benchmark several years ago to evaluate how companies are evolving on a net zero transition path by looking at a number of indicators such as what commitments has the company made, how is capital aligned with the energy transition, and how does company policy advocacy support or detract from climate efforts. This March, the benchmark included a new provisional indicator on accounting and audit, which evaluates how companies and their auditors are considering climate in financial reports. How climate will impact the balance sheet is at the very early stages of understanding, but critical as financial institutions are assessing where investment dollars are placed. The accounting and audit indicator is a tool that some investors are using to understand which companies are clearly telling the story of their climate strategy and how it will impact future value. The indicator evaluates three aspects of company financials. First, did the company consider climate impacts when drawing up the financials? Second, did the auditors test for climate effects in their review? And third, did the financial statement show that the company is on a net zero path? Rob Schuerk will talk more about the analysis and methodology, but I want to give you a sense of how investors are using the benchmark indicator. Investors understand that companies, specifically audit committees, have the most important role to play in overseeing the audit process, and that relevant climate data deserves the same rigor in the audit that financials receive. Investors want comfort that the board understands climate risk and appreciates the value of the independent process that the audit provides to investors. Auditors can test assumptions and bring in external specialists for an objective view of the company processes. We are seeing investors addressing accounting for climate in three ways. First, they're engaging companies to understand how climate is considered in financial reporting and the audit review to ensure that climate risk is on the list of things that the auditor should test in their process. They want companies to be clear about the assumptions that are used. A refiner that produces gasoline may have reasonably assumed 10 years ago that the plant would have a strong market in 2040. That future market looks very different today, with the shifts in consumer preference and directives to move away from the internal combustion engine. How is the company thinking about that shift? How might future revenues be impacted? Will those assets stop producing revenues sooner than anticipated? Does the company have funds set aside to clean up the impacts from that asset? This type of information can be a deciding factor in choosing to hold one company versus another as investors build resilient portfolios. Secondly, investors are filing resolutions. Earlier this year, resolutions at ExxonMobil filed by Catholic Brothers Investment Services and Chevron filed by As You Sow got very strong support with a majority vote at Exxon. The asks are straightforward. Provide a report on how the company financials could be impacted in a net zero transition using the assumptions provided by a model such as the International Energy Agency Net Zero Path. Test those assumptions that the company is using for commodity prices, demand, et cetera, against models that define a path for net zero. Report on how resilient the company would be. How would the company deliver value with oil prices of $35 a barrel or carbon prices of $200 a ton? Some companies are starting to disclose this information, which also sends a clear message that those firms are serious about their transition claims. Lastly, investors are engaging the broader community. They spoke clearly to the SEC in support of the climate disclosure rule and are speaking to audit firms, the PCAOB, and other US and international stakeholders. Investors are taking actions individually and through channels like the Ceres Accelerator for Capital Markets, a Ceres team that works to transform the practices and policies that govern capital markets in order to reduce the worst financial impacts of the climate crisis, and led by Stephen Rothstein, who's here today. Last year, Ceres published Lifting the Veil, Investor Expectations for Paris-Aligned Financial Reporting at Oil and Gas Companies, providing an analysis of how that industry should address climate change in order to comply with established U.S. financial disclosure standards and meet investor expectations. Investors are educating themselves to ask the right questions, setting expectations, and when companies don't respond, may use their votes. In sum, investors expect data that supports a climate execution strategy and audits that recognize climate risks are financial risks and treat it as such. Thank you, and now I'll turn that over to Rob Schuer.
Okay. Thanks, everybody. Great to be here today. Some of you may have come hoping to see my colleague, Barbara Davidson, who's the lead author on the report. For various reasons, she was unable, unfortunately, to attend, so I'm filling in. And those are some big shoes to fill. Let's see how I do. But I'm going to be talking a little bit about a report called Flying Blind 2. And it's the sequel to an analysis we did of a number of companies looking at the extent to which they had been able to incorporate climate-related matters into their financial statements. And when I talk about climate-related matters today, I'm going to be talking about both risks, could be physical risk, but also transition risks, the impact on a company's market or demand for its products, many of the items that Tracy was just talking about. Well, hopefully good. Okay, here we go. Good. Okay. So this report, again, is what is this report about? Let me tell you a little bit about that. So first is some background on how we got to writing these reports in the first place. We have seen since 2020 standard setters look at the need for companies to incorporate climate-related matters into the accounts. We've seen investor demand that is both for this to be done and also potentially goes beyond that to looking into how the companies need to be incorporating net zero ambitions or at least sensitizing some of their results to that. And then we've also seen market regulator action. And let's go through a little bit more of these in detail. So you can see here in 2020, we had the International Accounting Standards Board publish educational materials on it. The Financial Accounting Standards Board followed up, I think, in 2021. Looking at US GAAP. We've seen the International Audit and Assurance Standards Board also publish guidance, and the Big Six endorsed many of these through the Global Public Policy Committee that they're all members of. We've seen the audit firms join the Net Zero Financial Service Providers Alliance, which is, of course, not about the companies that they're participating in, but their own commitments. And then, of course, we've seen other emerging issues where there's going to be some intersection with financial reporting. So the International Sustainability Standards Board now conducting a consultation, thinking about how some of these items can be incorporated into the accounts. And of course, the SEC Climate Rule consultation, which is still ongoing. Consultation period has closed, but the SEC is still considering the massive amount of information that they received. So on top of this, right, we had the investor request as well. So we have over 110 trillion in assets under management, welcoming the guidance from the IASB. Last year, we had 34 members of the IIGCC, which is the Institutional Investor, I'm forgetting G, on climate change. A major European entity looking at asking for companies to actually go beyond what the guidance is and to say, look, we need to understand what your relationship to a net zero outcome is. How is that going to impact the financial statements? And then, of course, we had the resolutions, as Tracy mentioned too, in particular the one with Exxon, where a majority of Exxon shareholders did support it. These are the results from last year. Bottom line, it was not good. And what do we mean by not good? Well, we looked at a number of different areas. We have 7 areas that we're looking at right now. But I think the thing you could say is we're looking at both what companies need to do and what auditors need to do. There are some differences, and we can talk a little bit about that more, hopefully, on the panel that's coming up. But we're looking at a number of things. We're looking at what, are they actually demonstrating that they're taking climate-related matters into account? If they have identified things, for example, critical audit matters, any judgments or uncertainties that could significantly affect accounts, are they disclosing what assumptions were actually used in the accounts so that investors can come to their own view as to the prudence and the reasonableness of those assumptions that are really going to be significant in determining the results that are actually presented in the accounts. And then the third kind of area that we're looking at is consistency. And so are what the company's saying either in the front end or in its sustainability report or in its climate targets consistent with how financial results are reported in the back end. So here you can just see some of the questions that I've just kind of gone through here. This is looking for what we're looking for in the financials. And I should say, we are taking a global view. We're looking at the CA 100 companies. There are going to be nuances in accounting standards in individual jurisdictions. We are not taking those into account. But overall, the guidance from the IASB and FASB roughly consistent for our purposes. Okay, here we go. Right, and here's what are we looking for also in the audit reports. Now, I've put in green down here and also on the other slide what we would say is the additional request from investors. Okay. So let's talk a little bit about the scope of Flying Blind 2. 134 companies that we have reviewed. You can see here the breakdown in terms of geography. It's very heavily weighted towards the US and Europe, but there are also some other countries, companies from Africa, Asia, and elsewhere. So just one more thing about Flying Blind, what it is and what it isn't. So it's an analysis of disclosure of what companies and auditors have disclosed or required companies to disclose. It's not a critique of the sufficiency of any of the company's plans, whether they are adequately aligned with net zero. It's not an analysis of whether they're going to achieve their corporate targets based on that. That's other work that Carbon Tracker does do in some cases, but it's not this work here. This is really whether they have shown their work, right? I think it's important to know is it may be that there are lots of things that auditors are doing as part of the process, but if the disclosures aren't there, there's no way for anyone to know. So this is really about, can we see that the work was shown, okay? Now the top line, we haven't released this report yet. Top line is that there are small changes in the results, but mostly poor results as we had in the year prior. And I'm going to save that for when we release the report. And you're thinking, well, what are we presenting on? And what I am going to present instead, what we see there are some positive examples, okay? There are some examples of companies and auditors that have done some pretty good things and have demonstrated not only that, really that this can be done, but here it is, right? So we can, I think, hopefully have a conversation about how do we get to the place where we start having this information in all the reports, not just a few that I'm going to point out today. Okay, so here's some examples. Good, so this is looking at the findings from the financial reports. We'll do financial reports and then auditors and then the net zero issue. So these are the issues that we see in general. Most companies aren't providing sufficient information on how they factored climate into the financial statements. So we might see, for example, information in the risk factor disclosures that are talking about all the ways that there is expected financial impact from an energy transition, and then there will be nothing on it at all in the financial statements as to whether or not that's happening. I mean, this is an ongoing issue, and the question is, well, how did you actually take this into account? We can see the company has said, right, there's potentially material impact in the risk factors. How has this been taken into account? We have seen a greater uptick in companies disclosing some relevant assumptions and estimates, but very rarely are they comprehensive. So we may see that a company has said, okay, well, we think that there's going to be, we're anticipating lower prices. We're going to tell you the prices we've used, commodity prices going forward, we're going to use to test our assets for impairment. But there may be a secondary impact. You may have to retire some assets early. And there hasn't been any discussion as to whether or not that part has been considered, right? Do we expect assets to close early, therefore accelerating what are discounted asset retirement obligations on the books today? Let's go back to not yet. So, I've already talked about the narrative reporting here. And then another trend that we've seen is that we are still seeing, as we did in the prior year, the companies reporting to GAAP generally score poorer than those that are reporting under IASB to the ISIS there. Let's go to the next slide. And by the way, I thought I was clicking through these a second ago, so I appreciate whoever is taking over for that. Yes, thank you. Okay, so, all right, so, here's an example. This is BP's financials. We think they did a number of things right, okay? So what do I mean by that? So they really were demonstrating how they thought about climate-related matters being incorporated into financial reporting. They talked about the impacts of, and when I say climate, I mean transition risk and all those other things. I'm just going to call it climate, on upstream and downstream asset lives. So we had a discussion of that. We understood that, right? We're not here to judge that right now. We're here to understand how did they think about it, and that's important. They talked about how they shifted their long-term oil price assumptions based on the energy transition and how it was included actually when they were testing their assets for impairment. They showed consistency in how they were using those prices. Now, it doesn't mean it was a perfect report. We still have some questions about how they test a particular set of assets for goodwill based on assumptions of a continuing production of oil that remains relatively flat over the period over which they're testing the assets, even though they have a target to reduce production by 40%. But overall, there's a lot of good things going on in this report. And I think these are all things that companies could do. Let's go to the next slide. Okay, so this is for SSAB. This is a steelmaking company. It has an extraordinarily ambitious net zero target for carbon-free steel. You can read about it on their website. I think something by about 2026, they'll be launching this. And that's very impressive. What we noticed, though, was that there is nothing about how this is going to impact any of their infrastructure, any of their assets. It may not. Maybe they have a plan for that. But let's get it into the report so people can understand what impact it's actually going to have, right? So, this is a case where there is a lot of good things going on, it looks like, but we need to really understand how it impacts the financials, for better or worse. Let's go to the next slide. Let's talk a little bit now about some of the audit reports. And these are the basic takeaways. So first is that we don't see a lot of evidence of comprehensive consideration of climate in their audits. We are seeing more evidence of some consideration of climate in the audits, but I think it's got to be looking really across all areas that are potentially going to be affected. This is same pattern as we saw with US GAAP and ISB, which is that the PCAOB audit reports, none of them that we saw scored particularly well. We saw climate emissions evident in secondary PCAOB audit reports when compared with local ISA reports. So that is when a company's home jurisdiction is, let's say the UK or France, and has a secondary filing in the US, we will sometimes see inconsistencies where you have a critical audit matter or key audit matter be excluded from the US version of the report, even though it's in the other one. And this one is really difficult for us to understand why that would ever happen. Let's go to the next slide. So here's some good things that we think that EY did with Shell in its audit. So first of all, it's providing a lot of background information. Yes, these are not things that are explicitly required by any audit standard, but these are things that end up being highly relevant in talking about the issues which are material to this company. So they identified some of the scenarios that EY considered, that Shell considered, as potential inputs to assessing impairments. They assessed Shell as a going concern using the IEA net zero emissions carbon prices and low oil prices. They included a specific key audit matter that assessed the impacts of climate on a number of items, including impairments and decommissioning provisions. They assessed the risk of straining beyond 2030. There are still issues. In the scenario, for example, that they're looking at, you see demand decline substantially for petroleum products after 2030. And so that's a big drop-off point. Shell still anticipates having fossil assets after 2030. So we think it would still be sensible to go beyond that. But let's not ignore the fact that there are a lot of good things that were also going on in this report. Let's go to the next slide. Okay, good. So findings on net zero. So what we're seeing is that more than half of the companies that are in our study have actually made a net zero commitment of some sort. The quality of those varies greatly, but they have called it a net zero commitment. And even though that half these companies have made that commitment, almost nobody goes and checks to see whether any of the assumptions in which that world actually transpires is going to have an impact on the accounts. And so this is this one I think is, is this required under the standards? We could argue about that. I think no, but let's face it, companies are already doing this. And if they're already making those commitments, then we need to see some level of consistency on this. So let's go to the next slide. But there are some kind of interesting, there is one interesting example I'm going to say, and I'm going to put Glencore up for this, which is, the auditor said, look, the financial statements aren't prepared in line with net zero. The company doesn't think it's going to happen. Okay, well, you do have to be guided by what management thinks, but it's good to have that made explicitly, made explicit. But they also said, look, we're going to test on an impairment basis our thermal coal assets. And we're going to disclose what the impact would be if we were to have used those assumptions. And the impact was significant, actually. What they said in their report was we would write off 90% of the value of this, I think something about $8 billion worth of assets. We would write it off in that scenario if we were to have adopted it. That's significant. I mean, that's significant on a number of levels, right? That's obviously very material. It shows that companies and auditors can do these things, okay? Because now we see it in a report, and that means other people can think about it. And I should also say, I don't think the company's stock fell through the floor after that. And there's lots of ways you can interpret it, but I think to the extent there's anxiety out there about actually publishing this kind of information, I think probably it's overstated. And so let's go on to the next slide. So that's a good example of a company doing really what investors are seeking. So we have a bunch of recommendations here for auditors and others. You can see here, and I'll just tick through these really quick. How did they address climate matters? What was the thinking that went into this? Highly valuable. Ensure that there's consistency, not just within a report, but also across the group. We are still seeing changes in reporting in different jurisdictions, and that's not clear to us why that's happening. Ensure disclosure of relative quantitative assumptions and estimates. This may have been not a big deal in business as usual, but we're going to be in an era where there is going to be some significant variance as to what people think is going to happen in the future. And people want to interrogate, how prudent are the assumptions that are being made in these reports. A lot of times it's just about explaining and showing your work. Okay, you might have gotten to the right answer, but let's see the work. And I think that's what these last ones come by. Let's go to the next slide. So we have recommendations for everybody. So for regulators. So there is a role here. I mean, we are seeing a high level of inconsistency. There is a role for regulators to step in, not to drop the hammer, but just to be able to say, okay, well, look, how can you explain this? As companies have to articulate these, potential inconsistencies. Second is ensure that other information that's used for consistency checks goes beyond just the annual report. Okay, there is an increasing amount of highly valuable information that's about the company's strategy that sits outside that financial report. There are some jurisdictions, one could argue that, well, in the US, you don't really need to look at this other report or that other report. Okay, let's make sure that people do have to look at those, because that's all information that's going to investors and increasingly being used by them. So include these matters in oversight and enforcement reviews, and then take action in instances of noncompliance. Let's go on to the next one. So recommendations for investors. So, a part of this is about setting clear expectations so that auditors and the companies know exactly what they need to be aiming for. Second is, speak to the right people at the company. So there is wide latitude for audit committees to be able to set the scope of the audit. And that's a discussion that needs to be had, right, with the audit committee. These are the things that we would like to see. And of course, communicate those expectations. Now, private communications are great. There's other ways of communicating. You can communicate through voting, proxies, other things. Those are all options in order to escalate issues, particularly places where if you've tried to have that communication, it's been unsuccessful or fallen on deaf ears. And then last is engage with proxy advisors as well. And I know many of these things are being done by many investors, but in this area, in this particular issue, they probably need to be continued. Let's go to the next slide. Oh, and that's it. Yeah, well, look, thank you very much for listening today. I think we're going to take a short break and we're going to come back and have our panel. All right, well, thank you, everybody. As you're taking your seats, I'll just introduce this illustrious panel. On my left, we have Allison Heron-Lee. Allison Heron-Lee was appointed to the U.S. Security Exchange Commission, sworn into office in July of 2019, and served as the acting chair of the commission from January 2021 till mid-April 2021. Commissioner Lee brought to the SEC over 2 decades of experience as a securities law practitioner. She wrote, lectured, and taught courses internationally in Spain and Italy on financial regulation and corporate law. She's also served for over a decade in various roles at the SEC, including as counsel to former Commissioner Kara Stein and Senior Counsel in Division of Enforcement's Complex Financial Instruments Unit. Prior to government service, Lee was a partner at Sherman & Howard LLC, focusing on securities, antitrust, and commercial litigation. Next up, we have Jilly Lord. Jilly is the PwC UK audit partner and chartered accountant. She is a practicing audit partner, is a global leader for public policy and regulation. She's chair of the ICAEW's Audit and Assurance faculty and is a council member at the ICAEW. In October 2015, Jilly was awarded a Woman in the City of Women Achievement Award in the professional services category. And she regularly speaks and writes on a wide variety of topics, including the future of assurance, technology and assurance, professionalism and ethics, and diversity in business. And finally, we have Piers Hughes Smith, Investment Stewardship Manager at Franklin Templeton. Piers is the Global Stewardship Manager at Franklin Templeton. He leads the firm's enterprise-level work on asset stewardship, working directly for the Global Head of Sustainability, Ann Simpson, and collaboratively with the firm's specialist investment managers to enhance the firm's stewardship capabilities. Piers previously worked on active ownership at CCLA Investment Management, and well known for its active ownership and engagement work on behalf of not-for-profit institutional clients. So with this panel, as you can see, we have someone from a regulatory background, audit background, and investment background. And we're going to try and dive a little bit deeper into some of the issues that were raised in the Flying Blind 2 presentation. So as a quick reminder, basic overall point was that there was more that companies could do, even though there was some shining examples, and that it's really going to take a lot of actors to improve the disclosure in that area. What I want to explore today on this panel is sort of the what and the how these things are going to work. I'm going to start with Piers and really ask the kind of basic question of, what do investors need? And I imagine when we talk about investors, we're actually talking about a wide range of different groups, right? We're talking about what do stewardship people need in the firm, what do financial analysts need. There's going to be a wide range. We're not going to get to every one of those, but with respect to climate-related information, what will you do? What will Franklin Templeton do with it? And what is your ask of companies?
Yeah, well, no, thank you very much, Robert. And this is such an important set of issues that are becoming increasingly relevant. So we're thrilled to be able to speak here. But I want to go right back to what the role of investors really is, and what we need to do when we're allocating our clients' capital is appropriately manage risk and to allocate it to the best possible source and protect the proper efficiency of the marketplace. And in order to do that, we need comparable, consistent, and verifiable data for all forms of information that we digest, and that extends in particular to climate risk. And so what we're really asking for companies for is exactly that. We are members of the steering committee of Climate Action 100+, and through the Net Zero benchmark, investors, I think, have been very clear and very directive with their ask, and there's been great resolutions that have been filed at Exxon and others, and investors have taken this ask for fundamental disclosure on climate risk a very, very long way. And I think where we're really getting to now is we've gotten really meaningful disclosure. We're understanding that companies are exposed to this risk in a way that absolutely will manifest on their balance sheet at some point. And so now we really need support, I think, from the regulators and from the standards testers to get that last bit. You know, investors aren't the silver bullet. We can do a lot. We can file proposals and we can engage with management for change, and we can be supportive of the change that management's trying to implement. But what we can't do is create interoperable international standards for climate disclosure. And so we need to have this consistent set of data, and then the markets can really begin to digest this information in the way that they've always digested information. And it's very much our view that we need to be considering this in line with all of the information that we view to be financially relevant, and that the marketplace needs to do so in a way that's efficient and timely and reduces the asymmetries of information, which are just huge barriers to acting effectively. Because for some investors that we feel are very, for some investors who are very maybe they're on concentrated portfolios and they're able to spend time really digging into the risks that face these companies and read the footnotes in the accounts and go through every page of the proxy statement, which I know is something that I dread every year. But bigger investors and mainstream capital is not able to have the time and the resources to get into this. And so we need information that's simple to digest. We can incorporate it into our investment decision-making process and then act on it accordingly. And so reducing those barriers to entry of understanding the information and digesting it, I think, is very, very important for us.
That's great. Let me ask you a question. I mean, there has been a number of asks for some of this information that some people have traditionally called ESG. I don't think that's necessarily a fair label for a lot of this climate-related information, but nonetheless say, okay, why do you need, we would like to have this information in the audited financial statements. Is that important to Franklin Templeton as well, or not so much? If it is, why?
Yeah, and I think it goes back to my sort of earlier point around that this information is financially material. And we've had, so to take two good examples, we've had the Exxon resolution from Christian Brothers this year asking for what the IEA scenarios mean for their underlying assumptions and their financial statements. And and the reason why that's so important to understand that information is if you take a comparable action at BP, that resulted in really significant write-downs in their asset retirement obligations and their impairments, and that has a meaningful effect on the long-term view of the company. And we want to understand that as investors, not so we can necessarily make a moralistically based decision about it, but so, like all the other bits of information, we can take it into our process, we can make our own view on it, and then we can allocate capital accordingly and manage the risks that our portfolios are exposed to. But without that being translated to the financial statements, we're really missing the final piece of the puzzle. So when you include this in furnished disclosures rather than filed, we really miss that comparability, that verifiability. We need the auditors to be involved. And I think it goes back to what we're really looking to do is appropriately manage. And I'm glad what you made the comment about ESG, because what we're really looking to do here is not to do something that is the most sustainable thing in the world. What we're looking to do is to appropriately manage not only our economic capital, but our natural capital and our social capital. And that's really what we're trying to do. But we need reliable information across all of those capital stocks, because just like the economic capital stock, we need to not only understand how sensitive the issuer is, but we need to understand from a more holistic perspective how the issuer is impacting on those capital stocks as well. Because as we manage, I think going back to the very basic principles of what the financial markets consist of, which is the savings of ordinary people that we're trying to deploy in the best way to protect their wealth, then what we need to do there is to manage all three forms of capital so that we generate returns in a manner that doesn't hamper our ability to do so and limit the future productive capacity of the economy. And that's really what we're trying to do, but that really relies on verifiable information that is subject to reasonable assurance and can be relied upon by all investors to be consistent and comparable.
That's great, thank you. Shelley, let me turn to you quickly. So I would say, everybody here in their role as representative for, let's say, a sector of the value chain here, has responsibilities. I think the heaviest ones probably fall on the auditors. So auditors have a lot to do here. They've got to gatekeep. They've got to gatekeep for the benefit of investors. They've got to be mindful of regulation and regulatory risk for the companies. Companies have their own incentives for how they want to present the accounts as best, lawfully, but have their own incentives for how that wants to be presented. When we think about incorporating climate-related risk into the accounts, how do you think about, what are the, tell us, I guess just start us off with, what are the roles for management? What are the roles for the auditors? Where do you think, the obligations begin and end for the audit profession?
Okay, let me give that a go. So first of all, thank you for the invitation to be here today. I think the work that Carbon Track is doing is incredibly important. And so thank you for that as well. The reason I'm here fundamentally is that I agree that corporate reporting and audit should be a key enabler of getting us to a net zero transition. We have a really important role to play. And why do I say that? First of all, because I think we probably all share the worry about the climate emergency. But secondly, and we've heard this already this morning, there is no option for corporate reporting and audit. We can see that climate change is going to impact business models. And so at some point, as you said this, corporate reporting does need to reflect that and explain what's happening. But the question is how we do that. And I'll make a few comments about our current role as auditors and currently when we think about management in issuers and preparers, about how they're coming to the table. And I want to start off and think about the purpose of today's financial statements and the purpose of audit within this reporting system that we sit within. So when we look at financial statements that get prepared today, their core primary purpose is to present an account of performance for the last year and to give a picture of financial position at the balance sheet date. That's what financial statements set out to do, and that's what GAAP, whether it's US GAAP or IFRS, whatever, that's what GAAP intends to do. And the reason I start with that is that what financial statements are not primarily there to do is to talk about the future. As an auditor, and you mentioned I'm still an audit partner, so I still sign audit opinions, what my job is to look at those financial statements and say, well, do I think they are giving me a reasonable account of performance for the year that's just gone? Do I think they're giving the right position, the right picture of financial position at the balance sheet date? So that's what I do as an auditor. It's also important to remember that as an auditor, I'm not there to make decisions for management. It's really important, you'll probably all know this, as an auditor, I am independent of management and that I go and I take an objective view. So that's what financial statements and audit are here to do. Why is that relevant to today's discussion? And the reason it's really important is that what I've just described is a model that inherently is somewhat backwards looking. I'm looking at performance for the year that's just gone, and I'm looking at financial position at a balance sheet date. And when we think about climate risk, that gives us a bit of a challenge, really quite a big challenge, because climate risk is all about an uncertain future and about working out what's going to happen to a company and to its business model in the future. And you can see that we've got quite a fundamental tension there. Financial statements, which are primarily looking backwards, and climate risk, which we all care about desperately, which is about the future. Now, what you did and what the Flying Blind reports do well, and you touched on this in your presentation, there are aspects of GAAP and of balance sheet valuation that do require you to look at a future when you're doing impairment reviews, right? Or if you're making a provision for asset retirement obligations, yes, they do require you to look at a future. So we can use financial statements to give us a glimpse into the future and a glimpse of how companies are responding to climate risk. But it is always going to be a glimpse. It's not the primary purpose. And lots of the things that you address in Flying Blind, the things that I know frustrate people about today's financial reporting model, the reason those frustrations are there is because of this gap that we've got between financial statements giving us a historical view and this thirst that we've all got to think about climate risk in the future. So what can be done? The reason your work at Carbon Tracker is important is that it does push forward some incremental change. You've acknowledged this morning there's been what you described as some improvement in financial reporting and audit. I actually think there's been quite a lot. But the thing that is really important, and I was glad you referenced the really important role of standard setters. Right now, we've got the SEC, we've got the ISSB, we've got EFRAG in Europe, all working really hard on developing reporting standards that will require companies to give that future picture, a comprehensive future picture of climate risk and what it means. And at that point, we'll really be getting somewhere. That will be the kind of useful, comprehensive information that you're looking for. So the role of standard setters is incredibly important. The role of assurance, I think, will also be important. There's assurance standards also being developed, and there's a big challenge for my profession, actually. We're going to have a whole lot of new information. People are going to ask us to assure this, and me and some of my colleagues will go up and think, gosh, that's going to be hard, but we have to step up to that. There's a big job for us to do. And coming back to today's conversation, really helpful to help everybody in the system understand what is the information that investors and users need, to think about what can we do in today's model, and then really importantly, what do standard setters, regulators need to do to create a new model that's going to be better fit for purpose for the future.
Great, well, thanks for that. Let me ask you, just coming back to the points you're making, I mean, obviously there is a lot of the accounts are backwards looking, but as you acknowledge, there are pieces of it that are very much forwards looking and involve, estimates, assumptions, and judgments. And related to that, there is the obligation of the auditor to determine whether those things are reasonable. My question to you is, the reasonableness standard here has been around for a very long time. What has changed over the last couple of years in your view in the audit profession in thinking about the reasonableness of forward-looking assumptions, given all of the focus on climate? Has there been any change? Or would you say the practices are essentially the same as they've been 7, 8 years ago?
There's been a lot of change at the coalface. Yep, okay. There's been an awful lot of change at the coalface. So what's not changed very much are auditing standards. And also reporting standards haven't changed very much. There's been some really useful clarifications from standard setters, but the basic standards haven't changed. But what I can tell you, and I'll talk about my firm, but I think it's similar in many large auditing firms, is that we are working really hard to educate our people on climate risk and on how to think about climate risk and how it could impact the financial statements. What are those glimpses of the future that we do need to think about? So there's a lot of education going on. There's a lot of training, which we're rolling out throughout the PwC network. And there's a lot of what I would refer to as methodology being thought about in the major firms. So, for example, at PwC, if you're a practicing auditor, there's now a particular step that we'll follow in our audit files, which walks auditors through how to think about audit risk, how to think about climate risk, how to think about how that might impact the audit. And so at the coalface for people who are doing audits, an awful lot is changing.
Great, thanks for that. Well, let me bring Alison into the conversation. So, under your watch at the SEC, they took the most significant step the SEC's taken in terms of the climate-related financial disclosure rule. Well, that's not what it's called. That's what I'm calling it. But there was that came out earlier this year, or I guess it was in the last year. Can you tell us a little bit, just to start us off, with what you think are the most salient things in that rule? And then also those that relate to, the financial statements.
Sure. I want to start too by echoing what Jilly said, which is I think the work that Carbon Tracker is doing is tremendously valuable, and I want to thank you for that. And the same is true for Ceres in helping us all better understand some tremendously complex issues. And so the rule, just to give you a big picture of it, I see lots of summaries of this. They're in law firm memos and the like, but I have always thought of it in 5 parts. So it's risk, governance, strategy, then GHG emissions, and then the financial statement piece. And that's just I think a holistic way of understanding that there's a lot packed into each of those topics, but that is exactly, that covers the waterfront of what we tried to get at. Now, of course, risk governance strategy, that's from the TCFD framework, which I think has been extremely useful and very familiar for a lot of companies that are already thinking about and even reporting to that standard. The GHG emissions piece, in my personal view and from discussions with investors all over the world, might be the single most important, not important in this sense, important in how it's going to drive capital. A lot of money is going to change hands based on that number, which is why I'm very focused on the reliability and the verification process for that particular piece. And then the financial statement piece, I thought also was critical, right up there with GHG. And here's why. You rightly point out that there is not a lot in there, sort of in the rules right now about how to incorporate climate change. And it's not enough, in my view, to simply use the forward-looking pieces where you have to project future cash flows on line items. That's necessary but not sufficient. And so one of the things I think that will be, that in my view, that is quite critical about that piece is, as you know, and just for those of you who may not know, what we did in that piece, what they did, I have to see. What they did with that piece is they basically said, for line items in the financial statements, if an impact or a expense exceeds 1%, then you need to disaggregate that and explain it in a footnote. Now, we can debate a lot, and we have, whether 1% is the right amount. I'm less concerned or interested, I would say. That is a discussion we need to have, whether that's the right amount. But I'm more focused on the early sort of warning system, if you will, that will come from a disaggregation. So that information will be profoundly useful to investors, but in my view, it will be profoundly useful to management. I've had I've spoken to lots of CFOs all over the world who initiated conversations by saying to me, I don't have any idea how to do that. Which I get that, and we all need to be thinking about that, and maybe we need to do some guidance on it or some such thing, but think about what that means. What that means is they do not know how climate change is impacting their financials today. So my question back to them is, well, how are you going to figure that out? Don't you think that's important, and shouldn't you do that? So I think that piece, and imagine the trend lines that we will see if in fact a final rule is adopted at whatever threshold that disaggregation is. Imagine how the predictive nature of that, many times, of course, it's going to show great information. It's, there's opportunities there as well. But whatever it shows, it's going to help make those statements potentially more forward-looking, as you were pointing out. So that's how I think of the rule, and that is, I think that financial statement piece is critical. I would hate to see it dropped out of a final.
That's great to hear. Well, so, when I think about, forward-looking, we have the forward-looking stuff we're talking about, where you've got to make a prediction about what you expect to happen in the future with the cash flows. But I think you're talking about something else that's not forward-looking in nature, but over time creates a trend that can allow people to observe that. That relates, of course, to this information about greenhouse gas emissions and things. I'd be curious, from the public comments that were received, where are you seeing the various constituencies and stakeholders in this process on the question of the greenhouse gas emissions and on the financial statement piece?
So we got, just to level set, we got hundreds of thousands of letters, which I welcome. It's amazing, the data, and it's extremely helpful. And as much as time as the staff at the SEC spent on putting this together, they still were presented with information they had not considered. So the notice and comment process is real, and it's quite helpful for the agency. Now, so the comments, we try to distill them down. We try to reach out to the folks who we think have given particularly incisive thoughts and comments. On the financial statement piece, I will say that there's a lot of stuff I expected. I did not expect so much pushback on that piece, and there's been a fair amount. Plenty of people are supportive of it, including in the issuer community. Plenty of people think that we got the percentage threshold wrong. Again, fully understand and willing to have that discussion. But as I said, in my earlier remarks, the thing that I hear the most is we don't know how to do this. And they give me examples, like I'm talking to the CEO of a Fortune 50 company, and she says to me, is this a climate impact? Is this a climate impact? Where do I draw the line? How do I ring fence this? And what I think that has led me to, and I think and hope the staff as well to consider is that we need to have a conversation with the accounting firms, with the audit firms, and think about how best to potentially release some guidance in if there's a final rule. Or perhaps that's something that can happen down the road from that, but that has been one area that I think is really critically and important. So, for example, if you have a severe weather event somewhere, do you count that as an impact of climate change, or so that's just one of many very complicated hypotheticals that have been presented to me since we did that. But there's been that. The other piece where we've had a lot of discussion is, scope 3. Is scope 3 the right, are we ready for scope 3? Should we have scope 3 in the rule? We have it in there right now, only if it's material and only, or if you have a target that includes scope 3 emissions. So those are kind of two of the areas where we've seen a lot of challenge.
Right. Well, hopefully the take home isn't don't set a scope 3 target, because you might have to disclose. But
yeah.
I think it's a good idea, but I'm just,
I've heard that too, but I don't think companies are going to back away from their targets over that.
I don't think so either. I think the direction of travel is clear enough. They can't really do that. I think that's right. Well, look, one more quick question, then I want to come back to you, Julie, on some of this. So the in the rule, particularly in the financial statements portion, there was some reference to, look, some of the stuff that we're talking about here is already required. Okay, some of this is already required to be done. Do you have any thoughts on that? I mean, to what extent, what is the delta between obviously the 1% threshold, right? Which some people may like because it's clear, it's bright line. But are there other pieces of that rule that you'd say, well, some of this actually are already you have to do?
Well, setting aside the potential overlap from what's already required, I think it's good to sort of level set as to what was the state of nature before we put the proposal out, which is actually the state of nature we exist in right now. And I know most of you know we had put out guidance in 2010, and that hit 4 big picture areas. So risk factors, litigation proceedings, description of the business. These are all in Reg SK. They're not in Reg SX, meaning they're not subject to review by, well, they are subject to a limited review, but not reasonable assurance by the auditors. Sam is over here. She knows what I should have her up here answering these questions. But then the most important one, in my view, that exists currently is in the MD&A, the management's discussion and analysis, especially the known trends piece of MD&A. We have not seen much. I know it's no secret that since that guidance came out in 2010, we have not seen a lot of disclosure around those points. And the staff, I think, has has really geared up to start thinking about how to analyze current disclosures now that fall under that potential, all of those 4 potential rubrics. And they do, you know, as looking at your presentation, one of the, I think, really promising sources for helping both the staff and companies understand that is comparing what they put in their CSR reports to what is in their financials and looking for inconsistencies, not as a way of playing gotcha, but rather as a way of helping everyone identify what may be missing under current rules.
Right, that's excellent. That's great to hear. Well, so Julie, I'd love to hear if you have any thoughts on the SEC, but I also wanted to ask a little bit about the December 2020 letter that the Global Public Policy Committee said, the Big Six Global Public Policy Committee had, endorsing some of the standards that the IASB and IAASB had promulgated. And they said a couple things. I mean, the first they said, and I quote, "The environment and climate change in particular can have a potentially significant impact on companies' business models, cash flows, financial position, financial performance, and financial disclosures." And then it went on to say that while management and those charged with governance have the primary responsibility for the judgments, estimates and disclosures in the annual report and financial statements, the GPPC networks are committed to playing our part. And my question simply is, you know, where do you think that part is? What is that part in practical terms? What are the audit firms doing now and going to do in the future to work on this?
Okay, so I think there was a couple of questions in there.
Yeah, just, you know, as a quick 4 questions.
Okay,
That's all.
okay. So maybe just a quick word on the SEC rule, and in particular, I'll comment on the element of the SEC proposals that would require new disclosure within the financial statements. And we as a firm, and I, do support that. I think we may well have written lengthy responses about the 1% and whether that's the right approach. But I absolutely think that is the way forward. There are 2 things, in addition to everything that Alison explained, that I think are key about that, which, first of all, if it's in the financial statements, it's covered for issuers by the ICFR regime. So they will have to look at the quality of systems and controls in place to produce that information. I think that's incredibly important. We've heard this morning the fact that investors and users are really thirsty for that information, and so that means it's got to be of good quality. You've got to be able to rely on it. And ICFR is an absolutely foundational element there. So the stuff that goes in the financials, subject to ICFR, I think that's excellent. And of course, it will be subject to audit, to reasonable assurance. And again, I think that's really important in ensuring that the information is reliable. So for all of the reasons that Alison said, and those 2 extra pieces, getting that financial statements disclosure, I think, is critical. Let me come to GPPC. So GPPC is a group of, basically it's a group of people like me from the large audit firms who work together where appropriate, obviously under antitrust law, on matters which are relevant to global public policy. This area is top of the agenda at all of our meetings. So what is the GPPC doing? Number 1, and I hope this is really obvious, but I'm going to say it because it is so important. As audit firms, we have to do really high quality audits today. Full stop. No caveats there at all. So that is probably the most important thing we can do. But then what else are we doing? We work a lot with standard setters. Of course, we respond to consultations of the type that we've seen from the SEC, but we also talk informally with standard setters to contribute where we can and where it's appropriate to develop into standards that we think are genuinely going to push forward the public interest in this area. We've recently, as the GPPC firms, signed up to, you mentioned this, the very catchily named NZF SPA, the Net Zero Financial Services Providers Alliance, which again has meant that as firms, we've made a series of commitments as to what our role should be in the net zero transition. So in addition to doing high quality audits, there is a lot of stuff around the policy stage that the GPPC firms are working really hard on right now.
Great. Yeah. Well, so let me turn to you for a second, Piers. So, you know, there's this tremendous backdrop of effort that's happening at the regulatory level, at the standard setter level, at the level of the auditors themselves. When you go into companies and ask for additional information, I know part of the point you're making is we need standardization here, right? So it's not just, shouldn't be a bespoke interaction to get disclosure, but when you do, what are the kind of pushback that you hear from companies themselves, if at all?
Yeah, I think we probably come across a lot of the same pushback that the SEC would have reflected in its comment letters. You know, there's a lot of concerns around, well, how do we measure? How much is this going to cost? And I think what we've really tried to do is frame actually why we want this information in the hope that it can be better delivered. Because earlier I touched on that this is, you know, first off from a risk assessment point of view and understanding the full nature of risks our investments are exposed to. But also the other important thing here is the role of investors in the transition. You know, we are also a listed company, and we've made comments with both our listed hat on and our investor hat on, and we've also set net zero targets, so we're signatories to the also long acronym of the Net Zero Asset Managers Initiative, so we have our own target setting process, and we very much view that our role as investors in this is to transition the economy to net zero outcomes. And so what we need to do in order to do that is we need, first off, accountability from company boards to what they're saying on emissions. We need to hold them accountable for the information that they're providing. And that's really another reason why I think these have to be filed rather than furnished. And we also need the full suite of emissions information. So we've got a lot of pushback from companies around Scope 3, and we've been very supportive of why Scope 3 needs to be included. And so, you know, acknowledging that if we successfully manage to transition a handful of our portfolio companies to net zero, that's all well and good, and we may mitigate some idiosyncratic risks that they're facing in their transition. But climate change is a systemic risk, and in order to mitigate the physical effects of climate change in the long run, then actually we need a very systemic outcome and a systemic focus. And so Scope 3 is important because what we need to do is understand the economic linkages between emissions. We need to understand the value chain of emissions, and we need to be able to identify this common differentiated responsibility for emissions mitigation, which in sort of less complicated language means, you know, if we don't understand all the drivers of this, we understand that everyone's responsible, but we need to understand who, how much, and who can change it. And this is why all these scopes are important. And so we always try and reiterate this to companies when they push back on saying, well, you know, this is very hard to manage, this is complicated, but, you know, I think increasingly we're in the sort of post-target era now, and if you've gone to the, in setting targets, you'll have to do an emissions inventory. And so a lot of the pushback that we got around, well, we don't measure this, but they have set targets on it, and they've done an internal inventory, and so the information already exists in many cases, and the cost of achieving this information is falling all the time as data providers and other market services get more literate. And so we really think that a lot of these main issuer challenges are becoming quite quickly mitigated, and it's more about being very clear about what we're trying to use the information for, so that then we can have very targeted disclosure that's effective in not only being able to understand the full suite of risks and opportunities at our companies, but being able to steward our client assets effectively in driving the transition.
My question, I guess, on the back of that is, how well is this is a systemic risk issue sinking into issuers? Because I can imagine, you know, a lot of disclosure historically has been about information about the company for the sake of assessing the risk to the company. But the systemic picture brings another dimension too, right? I mean, it's like information about the company, given the risk, not just to this company, but to a whole portfolio of companies that participating in this course of travel, this, you know, energy consumption trajectory, we're going to have impacts on all. And so, I mean, I know that's a longstanding view that C1, you know, in the C100, for example, but, you know, how well is that sinking into issuers that like, oh, this is also about something bigger than just the corporate boundary?
Yeah, I mean, I think investors have kind of come to this realization first, right? Because the nature of a large diversified portfolio is more uniquely exposed to systemic risk than an individual issuer is. And we may have, you know, longer term interests that are aligned closer with long-term interests than necessarily the way that we measure profit on a quarterly basis is aligned. And so I think it comes to companies through a couple of different ways. It comes through investor pressure and just saying, well, fundamentally, we are your share owners, and this is something that we need you to address. I think it also comes through standard setters as well in pressure on companies because, and this is the point around interoperability is why it's so important, because this is one of the main areas of divergence in international standard setting is how you address systemic risk in all of these interpretations and guidance. And actually, so companies, I think, are quite rightly feeling a little bit squeezed because they have some standard setters saying they really care about impacts as well as dependencies. And then they have others saying that actually this assessment is not necessarily the way that they're going to go down with their standard setting approach. And so I think companies have a vested interest, as all people do, in making sure that we have an economy that is functioning at its best productive capacity, is using resources efficiently in the long term, and is not spending the progress of tomorrow on progress today. I think companies have a vested interest in the same way we all do, but they also have additional pressures pulling on them to do this, not only from their beneficial owners, but also from the markets in which they operate.
Mm-hmm. Great, thanks for that. And by the way, we are going to have some questions here from the audience. If for no other reason, I'll run out of questions. So feel free to raise your hand. I think someone's going to come around with a microphone in a second to be able to do that. I've got a couple more questions here, but then we could start going to those. Good. Well, Jillian, let me ask you: is there a moment of interaction that either PwC or the profession as a whole has in engaging with investors about these type of things? To say, look, at a systemic level, right? This is not a conversation about a given company. There's a conversation about, right? These are the kinds of things that we as a group of investors would like to see. What is that forum, and how does that work?
So there are many moments of interaction like that. So today is a great example. But if I go back to my work with the GPPC, in last calendar year, we convened 6 roundtables in different parts of the world with representatives from investor groups from whichever region we were in, to discuss this exact issue. Let us understand better exactly what information you are looking for, and then let's talk about how that might be reflected in financial statements at the moment, or if not, how standards need to change to address that. So that's, I think it's one of the most important things we do as the GPPC firms and as individual firms as well. Make sure that users of financial statements and annual reports know that our doors are open, and so they can come and talk to us about what they're looking for.
That's great. Super. And then one last question before we go to some questions in the audience, but for Allison. So, I when I think of it, what is a long arc of consideration of climate at the SEC, right? So we had the 2010 guidance that you mentioned, right? And then there's this revisiting of it 12 years later. What do you think has developed in the interim, in the context that is now making this the moment? Is it the right moment to have these kind of disclosures? What's in the mix that has given this a unique spot for us to have to really consolidate into regulation now?
I think that's a great question, and it's certainly one that I gave a lot of thought to as I began to explore if and how the SEC ought to become involved in this conversation. And you said it. Here's exactly the way I would say it in your answer to your first question, which is so the value add that we are in a position to do now that we were not in a position to do 10 years ago is consistency, comparability, reliability. Those 3 things are things that you will not get for the most part in a private ordering situation. But we've had a lot of private ordering going on for the last, some would say 20 years, but conservatively 10, maybe 5. There's been a real tipping point, I think, in the last maybe 3 years. But the TCFD protocols, the GHG protocol, there's been a lot of advancement and it's come organically from investor demand for companies to understand, embrace, disclose, transparency and accountability. You have to have both. You don't get a lot of accountability without regulatory involvement. So I think that because of that conversation between companies and their owners that's been going on now, vigorously, actually some would say it's historically unprecedented, the level of demand for information that's not otherwise required. And so they've come to a place where they have developed a pretty good framework, and we tried to leverage that at the SEC. And instead of come in and disturb, our view was, where's the market heading? This looks like, or I say our view, my view was, where's the market heading? What do people, what's working, what's not working? And now we are in a position to add value. Could we have done that from scratch in an effective way? I don't think so. So I think we are at a moment right now because of all the work that's been done in private ordering.
It's a really interesting commentary on how, sort of proto-regulation in the private sector, private sector space, public charities, whatever, outside of government, can be incubated and then kind of evolve. I think that's a fascinating observation. Well, why don't we go to questions in the audience? If anyone has any questions, Charlie, we got one up here. Charlie will bring you a microphone, largely for the benefit of the folks on Zoom.
Thank you very much. My name is Karina Litvak, and I am approaching this, well, as a former investor, but now serving on the board of an oil major that's dual listed. It's listed in Europe, it's listed on the New York Stock Exchange. And you talk about drawing inspiration from private ordering as a way of really accelerating and enhancing the quality of regulation. But what about drawing on the experience of other jurisdictions, particularly when your issuers are dual listed? And even if they're not dual listed, to the extent that they have multinational operations, they're operating in other jurisdictions, competing with peers who are subject to a regulatory framework that is way different and way ahead of the SEC. So to what extent, you mentioned, I think Jill, you mentioned EFRAG, to what extent do you foresee convergence between what the SEC is doing and what the European Commission has done with respect to double materiality, with respect to scope 3? I was really intrigued with your point. Sorry, well, there we go. With your point about how impacts feed into systemic risk. I think that's so insightful, and systemic risk, of course, affects investors. It affects all, issuers as well, dramatically. And I say this from the perspective of a company that has major impacts, but reliant on there being consistent regulations so that we can cut down our scope 3 emissions, or eliminate them, I should say. Thank you.
Should you want me to start with that, or
yeah.
I bet Jill has some things to say on that too.
Yeah.
So I will tell you that my personal view has long been that we have to have international coordination on this, and it was one of the very first things I did when I stepped into the role as acting chair, was reach out to the international community, FSB, IOSCO, all of those folks, both bilateral and multilateral conversations, to basically say, we're here. I got a lot of, it's just like World War II. You come in at the last minute. And I was like, I'll try not to, but I understood the point. But I also, I'm not alone in this at the SEC. I think the other commissioners agree the significance, because it's not just that we live in a global economy, but we're dealing with a global problem, right? So these piecemeal solutions that don't make sense for the global approach aren't going to work. But what we also know is that jurisdictions have very unique political considerations, any number of other types of legal considerations. There's all kinds of differences among jurisdictions. So we have to find a way to come up with what I hope will be like an international baseline, not a buffet, right? But a baseline that each jurisdiction can either accept or accept and build, depending on what your unique needs are. Are we getting there? I am not sure. But that it would be, for me, that's how I think we need to be thinking about it and approach it. And that's why I'm watching with great interest what's happening at the ISSB and other organizations like that.
Okay, and I can't resist commenting on
go
this.
ahead. Please do.
And first of all, Alison, I'm going to say that I'm going to shamelessly use baseline, not a buffet, everywhere I go, because that was just so brilliant. So I think the question you've asked is something that I am really worried about, and I think it's one of the most important things in the reporting landscape right now. And for probably most people do follow the sort of global developments, but we've got at least 3 standard setting regimes emerging right now. We've got the European Union and EFRAG, we've got the excellent work being done by the SEC, and then we've got the ISSB. And if we're not careful, we will end up with 3 slightly different regimes, and groups like yours may well have to comply with all of them. And that won't help investors, because you'll have things that look like they should be the same based on what it says on the tin, but actually are defined slightly differently. And it will create massive confusion and undermine where we're really trying to get to. So interoperability is something that we should all be pushing incredibly hard for. We do need a baseline, and we need those 3, let me call them standard setters, to agree on for that baseline, to agree on a convergence and aligned approach. That is something that I think, whatever our differences might be in terms of what we're doing today and so on, that I'd hope that everybody can be really aligned on and should be shouting for. It's immensely important.
Yeah, and also I just want to comment real quickly. I mean, I think investors are also great at creating complication and confusion for no apparent end, and so we don't really need any help. But one of the things that is so important on the interoperability point is that what we're aiming to do is drive transition in the real world economy, and so in order to do that, we can't have a uniform global approach, because there isn't, even though we have a uniform outcome of limiting global warming to 1.5 degrees, we need to bring in these ideas of, I think you referenced it really well, around the just transition and different cultural values and different paces of transition, different ways that maybe the transition will be non-linear, it'll be back-ended in some economies and front-ended in others, because notwithstanding that the global economy is structured a certain way, and the transition is expensive, both from a capital perspective, but also from an emissions budget perspective, and that building the technology that's going to get us to net zero is going to emit a lot of carbon. And so in creation of all these standards in the accounting, it needs to be interoperable, but it also needs to fit the jurisdictions, and it needs to respect what is going to result in an effective transition for the area that it covers. And I think so, as much as, I think investors say, well, we want consistent information, we do, but we also want it to be effective to end.
Great point. Do we have any other questions? I know I'm pushing us a bit over time, but take us to the half hour, though, and we'll go to lunch.
Thank you for a great panel. My name is Krisa Pagitsas. I'm the former head of ESG at Fannie Mae, so fully appreciate the role of the regulator and financial markets in this conversation. I think what's been interesting for me is not only seeing the investor perspective on publicly traded companies and the regulator's perspective, but actually how private companies are reacting. And what I've seen is, frankly, they're a little bit of a, well, you go first, and we are not going to act, meaning we're not going to act on carbon accounting, we're going to not put out an ESG policy. I'd love to know what your message is for those privately held companies that are not subject to these regulations today. What should they anticipate, and how quickly? How quickly should they be prepared to act?
Yeah, I can jump in on this one.
You've probably got some of this too.
I'll be brief, because I think others will have very insightful comments. But thank you. That's a great question, because private markets are much larger at this point than public ones. And there's also, I think, many people will have been spotting this trend of communication for people to sort of say, well, it's all well and good, public companies referencing climate risk and accounting for it, but then when they see the full picture in great detail, they then very quickly offload these high emitting assets into private markets. And I think that's potentially an unfair demonization, because private markets have this incredible role for transition. The control structures that exist, for instance, in private equity, and features of private equity investing like lockup can be incredibly effective in mitigating short-termism and creating more transition-focused investment objectives for private markets. And so we very much view private assets as having a real ability to drive change, not only through the control approach, but also that we can be very directive in allocating primary capital, whereas as a secondary market investor, your real tool for change is really engagement and voting. But as a primary capital investor, you can be very, very directional in absolute emissions. And so I think the fundamental request for private issuers is the same, which is we would also like to understand the risks that faces your business, much in the same way that we do in public ones. But I think you have to have a very different approach because of the nature of regulation. And there's some great efforts from data providers, I think like ILPA and Novata, that are going out and doing good work in the private space. But I think the ask to companies is much the same, public or private. Fundamentally, from an emissions perspective, the picture remains much unchanged. We would like to know about it and understand risk, and we would like to support companies in their transition to mitigating the risks that's faced by their business model. And I think that messaging is very consistent, but really it's the how we get there that changes.
So I am glad you asked that question, and I will tell you that, so everything Piers said is exactly right. And I will tell you that the day after the SEC's proposal went out, I switched gears and started thinking about that. And that is all I've been thinking about for quite a while. How do we bring some transparency into that space in a way that makes sense for, so that capital can continue to thrive and grow in that space, into, some on an IPO on-ramp, others, not, but nevertheless, it's an extremely important space. It's growing in terms of new capital that we know coming in each year. And so I think it's at a much more nascent stage. Now, those companies are going to be in the scope 3 emissions of a lot of people who are going to be disclosing, which is one reason why I think scope 3 is so important, because those companies can help those in their supply chains to understand the need to do that. Walmart is a great example. They have a program out now where they're trying to educate the folks upstream and downstream on how to reduce emissions in their supply chains. But I think we need a concerted effort. ILPA has done some promising work in this area, as have some of the larger private equity firms, but it's very scattered right now, and we need to reach something similar. Maybe it's TCFD, I don't know what it is, but I hope to spend some time helping on that effort, because it's critical.
Do we have one more question? We will get a break. Looks like maybe we'll just go to break. Well, look, I just want to give a big thank you to our panelists. I feel like this is really excellent and insightful. Thank you all, and thank you all for coming. So if I could just have your attention, we've got an excellent message here from Reverend Spalding. Are you going to speak? Okay. So let me just introduce Reverend Kirsten Snow Spalding, Senior Program Director at Ceres. She leads the Ceres Investor Network and all investor initiatives. She also represents Ceres on the West Coast as Director of Ceres' California office. Prior to joining Ceres, she served as Chief Deputy Treasurer under California's Treasurer Phil Angelides. And prior to her government service, Reverend Spalding worked in the labor movement as Chief of Staff for the California Labor Federation, AFL-CIO. With the California Sierra Club and the Ella Baker Center, Reverend Spalding co-founded the California Apollo Alliance, and for 6 years she chaired the Center for Labor Research and Education at the University of California, Berkeley, and taught at Bolt Hall School of Law. And so, Reverend Spalding, let me hand the floor to you.
Thank you so much, and I'm sorry to interrupt your break. that is why we're here. When I looked at the objectives for this conference, one of the things that came through was the desire to situate the work, the terrific work that's happening with Carbon Tracker and all of you on disclosure in relation to the net zero movement. So I wanted to speak just briefly about what I'm hearing from Ceres investor members. We manage a network of institutional investors, 260 plus now, about 60 trillion in assets under management. And I've been at Ceres long enough to hear sort of a trend, a movement that has gone from the demands that we made back in 2000, 2008, 2009. We were still asking for ESG reports. Very simple. And most of them we got came out of marketing departments. They weren't real data. We then went a big jump forward with TCFD, and we got more and more sophisticated about asking for those backward-looking today, point in time, what's happening around climate. And companies got pretty good at doing those TCFD reports. But today, I would say that the demands I'm hearing from investors to companies really focus on net zero. And I think that that trajectory from ESG reports to net zero commitments and solid transition plans is very significant in how it is together we're going to address the challenge of climate change. The transition plan demands now, all of you are working to get those transition plans into the financials, get them validated and verified, make sure that they are really investable data, not just a plan that guides the internal operations of the company, but a plan that investors can count on, can rely on as we make the investment decisions. I want to say also that I think there's been a trajectory in terms of how investors think about climate risk. It used to be that we thought one company had climate risks, physical risks, transition risks, and that one company could deal with that risk. But now more and more we see that those risks don't hit just one company or even one sector, but they hit every sector and need to be addressed across global capital markets. The panel that you just heard really got to how it is we collectively are going to have to work with regulators and all of our demands on the investor side, our actions on the corporate side to begin to address this globally. I would say that the approach of the investors has also shifted. That today, what we're seeing is that there's a focus on the heaviest emitting companies. That's a first starting place. And Tracy mentioned Climate Action 100 Plus, that is an initiative where investors have come together collectively to look at those sectors where emissions start. But we don't stop there. And I think now, as I look forward to the 23 proxy season, our investors are very much focused on where the finance sector is supporting those emissions. So we're going to see a lot of emphasis on the banks and other actors who are enabling the low carbon transition and those who are frankly lagging behind. I want to say that the shift in approach also includes a broadening of some of the topics. It used to be just CO2, and now we're recognizing that it's much more than CO2. One of the critical issues that is coming through in all of the dialogues that we're having with investors is the sense of a just transition. If we do not include the workforce and the communities, those frontline communities that have been impacted by the heavy emissions in the past and will be on the forefront of building the low carbon economy that we need, we will not see the transition that is necessary. So the investors are not just asking companies to disclose how just transition fits into their transition plans, but investors themselves are beginning to engage with frontline communities and the unions or the workforce directly where it will be necessary to make the shifts at the speed and scope that's required. I would say that as the movement towards net zero becomes more comprehensive, not only are we saying not one company, not one sector must sort of broaden out, we also have to think about policy as a partner in this. So policymakers become a focus of investor engagement. Investors are asking companies, where are your lobbying dollars going? What are your industry associations saying to policymakers? Are your own, you the investor, are your own policy advocacy efforts going to really support the transition that we need? I think that the work that the Commission, the SEC has done and that our global financial regulators are doing is supportive. But again, we have to ask the companies to support that kind of robust disclosure, and we have to ask investors themselves thousands of letters coming in, but frankly, they're not as aligned as they must be to address the net zero economy of the future. I want to note that it is not only a matter of risk, and we've talked quite a bit about risk over the course of the last couple of hours, but it's also about opportunity. As we look forward to the low carbon economy that's coming, every investor wants to know, where are your capital expenditures? To what extent are you investing in the technologies of the future? The rubber hits the road not with what you plan to do in the future, but what you're spending on today. So those disclosures become critical for investors. Investors want to align their own dollars with the dollars of the companies that are moving as at the forefront of this transition. So we're seeing a lot more emphasis on investment in climate solutions and investment particularly in emerging markets where those solutions are most critical. Finally, I want to say that for all of you here, you think of yourselves maybe as deep dive experts in your part of these challenges. You are the auditors, the people who write the financial reports, the investors who use those financial reports, the NGOs who are supporting it. But today I would say you are also part of building a movement. We had a fun event with Climate Arc last night where everybody clapped their hands and talked about culture change. A culture change at a moment when the answers maybe are not all clear. But together, the companies, the investors, the regulators, the policymakers must find a way to move at the speed and depth that is required to address the challenges of climate change and to change our global capital markets. Thank you all for having me. I'm delighted to see all of you doing such important work.